This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In this chapter, we're going to look at partnerships. Now, as the first introductory sentence tells us, that a partnership is a single trading entity, but for tax purposes, each individual partner is treated as though trading in his own right. So, if you can do the rules for sole traders, i.e. adjust profits, do capital allowances, and basis periods, then you can do partnerships. So you'll notice this is only a very short chapter. Now, if you haven't done those chapters discussing profits and what adjustments we need to make, all the capital allowances and how that works, and the opening year's rules, the closing year's rules, and the current year basis for basis periods, then you really shouldn't be doing this chapter yet. Pause this chapter and go back and do those ones that I've mentioned there, because that information is assumed knowledge when you're doing this. I might recap one or two things, but I'm assuming that you've done those chapters before you've come to this one. As I've mentioned before, these chapters are put in a logical, progressive order so that you can do them one at a time, and each one builds on the next one. Okay, so it is essential to understand, therefore, that it is not the partnership itself that is being assessed, but each individual partner. And we'll see that as we go through the chapters. So the adjusted profits, exactly the same as a sole trader. The one thing you need to look out for are partners' salaries and interest on capital. Okay, they are not, I repeat, not expenses, because they are simply what's known as the allocation of the profits, and they need to be added back. So if you're doing a partnership account and you're adjusting their profits and you see those two details, either interest on capital or salaries, then you need to add them back in your adjustments. Now, the allocation of that, so what we've got here is we've got a partnership. I liken this to a bucket. Okay, we have a bucket, and in that bucket is all the profits. You've adjusted them, you've done the capital allowances, and you've done the basis period, so you know what's going to be assessed on each individual partner in this tax year. So these are the profits for a tax year. It says it needs to then be divided between the partners according to the profit sharing ratio. Normally there are first salaries, so that comes out of the bucket. It's not as well as. Interest on capital comes out of the bucket, which then means you've got the balance of the profits, which are then in the profit sharing ratio. And this example here, we're going to have a look at that. This is the sort of, these little questions here, sort of thing that you might get in a multiple choice question. So the profit sharing ratio will be for a period of account. Normally it's for 12 months. If, however, there's a change during the year, we can deal with that. It just means that we've got to do it twice. But again, if we have to do it twice because there's been a change halfway through, we've still got one bucket. If we have to do it twice, then you have to separate it into whichever proportion the question tells you. But the bucket is still the bucket, and that's the total. And you'll see that as we go through the examples. So let's look at example number 1, Doug and Rob. They've been in partnership, and for the year ended 30th of September 2022, there was £18,000. That's our bucket. All right. Now, up to the 30th of June 23, it was shared 3-2 after paying salaries of £3,000 and 2,000. So that's 3,000 for Doug and 2,000 for Rob. That's the way it's laid out in the question. However, from the 1st of July 2023, the profits were shared 2 to 1 after paying different salaries, salary of 6 per year and 4,000 per year. So we've got to allocate those profits for the period, the accounting period ended the 30th of September. Let me show you how that looks in an answer. First things first, if you're going to do this, excuse me, we need to show quite clearly. Now, please don't use the word bucket in your answer. It's just an illustration to help you to grasp what we're on about. So for the accounting year ended 30th of September, we have £18,000, which we have to divide between Doug and Rob, given the information in the question. Now, I've divided it, you can see there, into 2 periods of account. According to the question, I have split those according to the date. So from the 1st of October 22 until the 30th of June, which is 9 months long, the profits that we need to allocate in that 9-month period is that. That's the share of the bucket in that 9-month period. Now, they had salaries, so 9/12 of the salaries in the questions, that needs to be allocated first, which gives us a total of 3,750. Now, the total altogether is 13,500, so that is a balancing figure, which is then allocated 3 to 2. So they've now got 8,100 and 5,400. That's what Doug's got, that's what Rob's got. But that's only part of the question. From the 1st of July, the profit sharing ratio changed, and so did the salaries. Now that's only a 3-month period, and that is the total, because those two add up to the 18,000. So we've only got £4,500 to allocate in that period of time. Firstly, we always do the salaries, which gave us this amount, 2,500. Now the total, that's the total that we are allocating, which means that is a balancing figure, and it's shared 2 to 1. So when we allocate 2,000, 2 to 1, and then we add them up, giving us 2,833 and 1,667. If we add the two together, we have allocated in total 18,000 over these 2 periods, and Doug has 10,933 and Rob has 7,067. Rob will now be assessable on that. That needs to go in his income tax computation, and that needs to be dealt with accordingly. And again, you should have watched that lecture chapter before coming to this point. Capital allowances for partners. Okay, that's just normal. We've discussed that already. It's just do it in the normal way. Very rarely do you get assets used privately, unless it's a car, but they rarely have their own private assets that they include and need their own private capital allowances. You won't have to deal with that. Now, commencement and cessation. We're down to back to basis periods here. That's a whole chapter in itself, which you should have watched and taken in the knowledge of before you come to this. So, rules of commencement and cessation. When a partner joins or leaves the partnership, is the same as it is for a sole trader. So there's no new rules to it. Hey, no new rules. The profits are allocated between the partners for the accounting period, and then the assessment rules apply. All right. So with those figures that we had for Rob and Bob, that then you need to do the basis periods to work that out. So they're effectively being taxed as sole traders on their share of the bucket. So if they are continuing, and they have been for many years, current year basis. When they join, you use the opening year rules. And when they, a partner leaves, okay, he's treated individually, not the partnership, he's treated as ceasing to trade. And then you've got the closing year rules, and each one has its own overlap profits because they are treated as sole traders. So when we've done, let me just thoughts just gone through my head. So when we adjust profits, which we've done before, and we deduct the capital allowances, previously we've just gone straight on to basis periods. Now, instead of doing that, we've got a 2A, which is the allocation, the allocating of profits, and then we do basis periods. So there's just that extra stage in the middle that needs to be dealt with, which is the allocating of the profits, which is, to be honest, it's maths. You've got 18,000, you've got some instructions, and you need to divide it between whoever's there for whatever time. It's maths, and you can all do maths. I know you can. I have confidence in your abilities. Okay. So, any change in a partnership, as long as one of them is still there, then it still continues. And commencement and cessation rules only apply when they start and they leave. So let's have a look at Anne and Beryl. Now, they've been in partnership since 2020, and they make up their accounts to the 30th of June. Now, on the 1st of July 2022, Claire joins. And these are the profits that we need to allocate. Now, they can all be allocated equally. Now, there is no mention of salaries or interest. If there's no mention, don't assume, just follow the question carefully. So let's have a look at the answer to that one. Okay, so example number 2, the question asked us to allocate the trade income for the accounting period between the partners. So this is how we would need to do it. The profits need to be allocated. So they've been adjusted. We've done capital allowances. This is step 2A. Let me write it on there so you can see. This is step 2A, which is the allocation. These are the year ends. That is the total. So that's, if you copy that from the question, copy it carefully, then put in the various different partners, and then according to the instructions in the question, allocate those profits. So in the year to 22, the total of 12 was allocated 50-50 because it was equal. Then in the year to 23, it was allocated 50-50 because there's only 2 of them. Now, Claire joined in the year to June 24, and therefore that 24,000 profit needs to be split equally between them. They're all treated then as sole traders. Now, Anne and Beryl. So this is our basis period. Now, if you've got 2 partners that are in exactly the same situation, you don't need to show it twice. Just put both names at the top of the computation. So they commenced on the 1st of July. So this is your, remember before we did the year, basis of assessment, and workings. And then what needs to go, what is being assessed and needs to go into the income tax computation. Exactly the same as we've done before with basis periods. They both have the same rules because they joined at the same time. So they joined here. Go to the next 5th of April, which is an actual basis. So don't forget to write the rules in. That's what you're getting the marks for. show your working, and then the assessed amount. Then she's clearly on a current year basis, both of them are, because there is a set of accounts in year 2 with a year end. That is June 22. It is 12 months long, and then we're straight on to current year basis. And they have overlap profits because that bit there, that 4,500 is being assessed twice. It's being assessed there, and therefore they have overlap profits of 4,500. And then Claire, she started 1st of July 23. So she's on an actual basis in 23-24, exactly the same. This is the year. This is the basis of assessment. This is the workings. And that's what's going to go into her tax computation as her profits that she's received, with overlap profits of 6. Now, if you've done the basis period chapter and listened to the recording, the lecture on that, this should all make sense because you'll have done it. And you'll find that partnerships, if they come up in the exam and you can do individuals, partnerships is a way of getting lots of lovely marks, which is what we want. Now, losses. If we haven't done the losses chapter yet, it's to be dealt with later if you're doing it in the order that they are in the manual. However, that will make sense when you come back to it. Losses are allocated same way as profits. The loss relief claims, same as sole traders. Each partner will choose. Okay. So you can either carry it forward if they're continuing, or you can do current or previous years, and therefore extend into chargeable gains. And a partner joining a partnership may choose the opening year's loss relief. And we have here an example. Oh, it's been one more. Claim terminal loss relief when you leave, if you so choose. Exactly the same rules. Same rules as a sole trader. So make sure you read. So you read the losses chapter and watch the lecture. Okay, and a simple example that we've got here. John, James and Paul are in partnership. During 2023-24, Paul left and George joined. So the claims, what can they claim? Okay, what can they claim? So let's have a look. Easy one first. Paul, he left. Okay, so he can claim, if he wants to, current year or previous year. He can't claim carry forward because he's left, but he could claim terminal loss relief. Okay, George, he joined, so he can claim current year but not previous year, because obviously he wasn't in partnership then. He can claim carry forward if he wants, or he could claim the opening years, the special opening years rules for loss relief, and carry that back 3 years on a FIFO basis to relieve and maybe get an income tax refund from income he had before he joined. Now these two, not three because Paul's left, these two, current year, previous year, carry forward. And whenever they started, we don't know because the question doesn't ask. They could use the opening years, but we don't know when they started, so that's probably not applicable. So partnerships, fairly straightforward chapter because it brings together all the knowledge that we have from elsewhere. Adjusting profits, capital allowances, losses. And then there's a lot of maths involved in allocating those between everything else. All of those things are in other chapters, so you need to read those chapters, watch the recordings and lectures, and make sure you have all that information, because when you do, this chapter should be simple. Okay, all right, and when you have done that, chapter 15 in the practice questions is one that you can do to make sure that you've got this knowledge down. Well done.